Benjamin Graham once said that the investor's chief problem, even his worst enemy, is likely to be himself. And I'm going to spend most of the next hour talking about things that investors do that make them their own worst enemy. I'll focus at first and primarily on individual investors, but I'm also going to talk about some things that get in the way of institutional investors. But before I get started, given the audience, I wanted to tell you why I think finance is harder than accounting. All right? And here's the reason. The reason is that to do accounting, you have to be able to add and subtract. But to really understand finance, you have to understand probability. And human beings have a very good intuitive grasp of quantities. We add and subtract really well. We can judge quantities pretty well, just intuitively. We do not have a good intuitive grasp of probability. And for that reason, we end up using a lot of mental shortcuts to deal with probability, and sometimes they serve us well, and sometimes they predictably lead us astray. So here's my little demonstration as to why I think that's true. 2 plus 2. Everyone knows what 2 plus 2 is, right? Little kids know what 2 plus 2 is. There are occasional exceptions. I know these days, if you ask an accountant what's 2 plus 2, he's likely to reply, well, what do you need it to be? I think the rest of us would agree 4. Okay, it's a simple addition problem. Let me give you a simple probability problem. What if I were to flip 2 coins? If I flip 2 coins, what's the probability that both coins come up heads? How many of you are pretty sure you know the answer to that? I think most of you do, right? 25%, 1 out of 4. Easy enough. Now let me make both problems a little harder. Anyone get that? 8 apples. You're not even going, no one's even going 1, 2, 3, 4, 5, 6, 7, 8. You look at it. You say 8 apples, no problem. Let me make the probability problem a little harder. Instead of flipping 2 coins, I'm going to flip 4 coins. And the question's going to be, what's the probability that any one of those coins comes up tails and the other 3 come up heads? And I don't care at all about the order. So what's the probability of getting 1 tail and 3 heads if you flip 4 coins? How many of you are sure you know the answer to that? We got 1 hand. What's that? 1/44th? 1/24th? No, it's a good guess. Actually, usually nobody knows. It's also 1/4. It's, if you specify the order, it's 1/16. You know, I gave a talk at Google the day before they went public, and I posed this problem. And there were about 200 or 250 engineers in the room, software engineers. And about 20 of them knew the answer. And I asked those 20, I said, well, did you ever take a course in how to do this? You know, a combination and permutations course. And they all said, yeah, of course we did. And then I said, well, what about the rest of you guys? And they would sort of say, well, you know, it was a long time ago, and we don't do that very often. And, you know, I could have done it when I took the course. Probability, we can learn probability, but it doesn't come to us intuitively. It doesn't come easily. And if we don't deal with it regularly, we generally forget. Now, you might look at this and say, yeah, people don't remember the formula, but I bet they come pretty close. I don't think so. I haven't done a formal study of this, but my youngest daughter did a school project once where she went down to the local Pete's coffee shop on a Sunday morning and asked people questions about the outcomes of flipping 3 coins. And we tabulated all the answers. They were all over the place. There was no convergence towards the right answer. Okay, so we have difficulty with probability. It doesn't come to us intuitively. And so we use a lot of mental shortcuts or heuristics to deal with probabilities. I'll give you an example. I want you to think of a company that went public since 2000 that's been very successful. All right? Quite possibly some of you thought of this company, partially because it's in the news, you see it every day, partially because I sort of primed you by mentioning it a moment ago. But it wasn't that hard, I suspect, for most of you to think of a very successful company. Now I'd like you to think of a company that went public since 2000 that's now bankrupt. Is that easier or is it harder? Most people find it harder to think of a company that's gone public and then gone, recently and then gone bankrupt than a company that's recently gone public and has been very successful. Is that because there are more very successful companies than companies that fail? No. But the failures mostly get forgotten. There are spectacular failures, Enron, WorldCom, MF Global. But unless a company blows up and is all over the news, it just fades out of memory. So why does that matter? Well, suppose an individual investor is thinking about buying a high-tech IPO. And he says to himself, well, I wonder how likely it is that this is going to be a big success. And he thinks about the companies he wished he had bought. He says, oh, I really wish I'd bought some Google if I'd been around when Apple went public. And now even Facebook has recovered, and it's looking pretty good. I think that high-tech bets are probably a good bet, high-tech IPOs. But then he says to himself, well, I know they don't all succeed. I wonder how often they fail. And he scratches his head, and he thinks back and says, well, I guess Pets.com isn't around anymore. But he has more difficulty thinking of the failures because they mostly failed quietly. So using this very typical mental shortcut to estimate probabilities by how easily examples come to mind, the investor is going to overestimate the likelihood that he will be successful. So I'm going to start off talking about individual investors and some of the things that affect their decision making. I'll talk about a couple of biases, talk briefly about emotions, and then about attention and limited attention. So the first bias I want to discuss is overconfidence. And by that I mean thinking you know more than you do, thinking that you have more ability than you actually do. When I teach MBAs, in one of my first classes, I hand out a questionnaire. And it reads something like this. Look around the room at the other students in the room with you, many of whom you may not know, and estimate how good of a driver you think you are compared to these other students. Well, typically about a quarter of the class ranks themselves in the top 10%. Half the class ranks themselves in the top quartile, and all but one or two students rank themselves above average. Several years ago, I asked a young woman who had ranked herself just basically, in the middle, why that was the case, and she said, well, I was going to put myself above average, and then I thought about it, and I realized, in the last year I've gotten 3 speeding tickets, I've caused 2 traffic accidents, and next month I have to go to court or else they're going to suspend my license. Maybe I'm just average. But the rest of us are above average. So, and that goes for, I'm sure you are all above average CPAs, and I'm sure that all investors are above average investors. And, I took a look when I was writing my dissertation. I wrote a theoretical paper about what happens in a market when everyone's above average, when all the investors think they know more than they do. And basically, I'll come back to that. Basically, what I found was that people traded more, they earned less, they tended to under-diversify because they were sure they were right, and market volatility went up. So I wanted to test, I wanted to test this theoretical prediction, and I was able to obtain trading records from a discount brokerage firm. And I thought, okay, my theory says that overconfidence is going to lead people to trade more. Let's see if they're trading too much. And I thought, well, a reasonable expectation when you sell one stock and buy another is that the stock you buy will outperform the one you sold by enough to cover your trading costs. Certainly, if you're trading for speculative purposes, you want that to happen more often than not. So I took a look to see what was happening to the stocks after these people sold them and what happened after they bought them. And I found that the stocks that they bought, on average, went on to underperform the ones they had just sold. And the shortfall was about 3 percentage points over the next year. On top of that, of course, they were paying commissions and they were paying spreads. And I don't have this slide here, but basically I went and I filtered through the trades and tried to cut out as best I could tax loss selling trades and rebalancing trades. And when I narrowed the set down to trades that were more likely to have been made for speculative purposes, the results didn't get better, they actually got worse. Now the shortfall was 5 or 6% a year between what the people bought and what they sold. Now I revisited this same idea that people were trading too much and that overconfidence was likely one of the causes. With a different data set, we had 78,000 households, 66,000 of them were trading common stocks. And I did this follow-up study with my friend and colleague Brad Barber. And we took these 66,000 households that were trading common stocks and we divided them up into 5 groups based on how actively they traded. And our prediction, our hypothesis was that the active traders were going to do worse than the buy and hold investors, and indeed that's what we found. In fact, here on the left, the little green bar, that's the turnover rate for the buy and hold investors. The green turnover who are on average less overconfident. As it turns out, on average, men and women differ in their overconfidence, and particularly in areas such as finance and mathematical sciences. What surprises a lot of people is to find out it's men who are more overconfident, not women. So we separated our sample into men and women. And our prediction was that men would trade more actively than women, and that the trading that men did would hurt their returns. And sure enough, that's what we found. Men traded 45% more actively than women. Single men traded 67% more actively than single women. On the return side, what we did was very simple. We wanted to see the effect of trading on people's returns. So each year, we took a look at what was in each portfolio at the beginning of the year, and we calculated what that investor would have earned if he or she had taken a buy and a hold approach for the whole year. Then we went back and we calculated what that investor actually did earn. Net of commissions, net of spreads, what did that portfolio return for the year? We subtracted the buy and hold return, the return the person would have had if they had done nothing, from what they actually earned. Now, it won't surprise you after what I've been discussing to find out that on average, both men and women underperformed the buy and hold approach. But men underperformed by 1 percentage point more a year than women. Single men by 1.4 percentage points more a year than single women. I'm going to talk briefly about emotions. I've been working on an experimental study with a couple of colleagues. It's called Bubbling with Emotion. And what we do in this study is we have people, mostly students, some staff, come to our experimental economics lab. They sit down in front of a computer. We train them to trade the fictitious, sort of fictitious stock on the computer. They're trading with each other. And we're using a protocol that's been studied. It was developed by Vernon Smith, who was the co-recipient of the 2002 Nobel Prize in Economics. So we're using a very standard protocol that's been studied quite a bit. We do one variation on that protocol, which is after training people and before they trade in the actual session, we ask them to watch a 5-minute video. And sometimes we ask them to watch an exciting video. And sometimes we ask them to watch a historical documentary that lacks for excitement, pretty boring or neutral. And what we find is that in the trading afterwards, we get much bigger speculative bubbles if we ask people to watch an exciting video than if they have watched a more neutral or boring video. And I think that what's going on, this is, of course, what we expected to find, that when people were excited, that they would start speculating and trade, and that this would fuel a bubble. And what motivated us to do this study was memories of back in 1998, 1999, early 2000, when there was a high-tech bubble and the sort of excitement that we observed. I went to have lunch with a friend of mine who's an attorney one day in San Francisco. I arrived. He said, "I'm sorry, I can't take a long enough break to go to lunch. Why don't you come up to my office? We'll talk for a few minutes." I was in his office for about 20 or 25 minutes. He checked his stock portfolio 3 times. I mean, people were obsessed. In any case, what we think goes on, one of the things that drives bubbles, there's probably 2 major drivers. The big one is that people believe that whatever has gone up recently will go up more. People chase performance. And that, of course, puts buying pressure on whatever it is that has been going up, and it creates this feedback loop. And we suspect the other thing that contributes to the feedback loop is this emotional component, that people get excited, they're making money, other people are making money, other people are excited, it's sort of contagious, and the critical decision-making falls off to a certain extent. Another way, so that's sort of an active or hot emotion, excitement. Other sorts of emotions affect investing as well, and one is regret. If you buy a stock and you sell it for a gain, how do you feel? How do most people feel? They mostly feel pretty good. And if you buy a stock and you later sell it for a loss, how do you feel? Most people don't feel so good. So which is more fun, selling for a gain or selling for a loss? Clearly, it's more fun to sell for a gain. Now, ideally, what you would do is just pick stocks that were going up. There was, I think it was Will Rogers once said, don't gamble, take all your money and buy a good stock and sell it when it goes up. If it don't go up, don't buy it. Well, it's good advice if you can follow it. What most investors do is they simply hold on to their losers. They call them paper losses. They imagine that they're going to jump back. I've done a lot of studies of this. This is called the disposition effect, the tendency to hold on to your losers and sell winners. I've done it with U.S. investors. The interesting thing with U.S. investors is the only time that I've studied a few different data sets. The only times that we find people selling their losers as a group is in December. And that's when sort of people become aware of taxes. And of course, from a tax perspective, as you all know, if it's in a taxable account, it makes more sense to sell your losers. This study is from Taiwan, and I put it up because we actually look at every single investor in Taiwan. From the stock exchange, we got the records for every single investor, institutional and individual. And the bar basically, what the bar is measuring is this, where it says 4 for the individual investor. That means that if an individual investor went to bed last night with 2 stocks, one held for a gain and one held for a loss, he's 4 times as likely to sell the winner today as the loser. That's a much bigger disposition effect than I found with U.S. investors. It was about half as much in the U.S. They were about twice as likely to sell the winner as a loser. And in Taiwan, we found that for the institutions, for the corporate investors, in this study, the foreign investors in the mutual funds didn't exhibit this behavior. But other studies of U.S. mutual fund investors have found the same behavior. Even institutional investors will tend to hold on to their losers and sell their winners. Okay. I'd like to try to wake you up with a little quiz. I realize it's tough to sit in a room with 1,000 people in the morning, and many of you are probably out late last night. And I find that for my students, there's nothing like a pop quiz to get their attention. So I take it some of you missed the gorilla, huh? Amazing. Well, that's because attention is a limited resource. And when we focus our attention on one thing, we tend to miss other things. And it's a very powerful thing. You know, I've done one study that relates to attention. I've seen a few more. I think there's a lot of research to come here because I believe that, especially with multidimensional decisions that, where there are a lot of things that matter, what you focus on and what you pay attention to and what you ignore probably makes a bigger difference in the decision you make often than what your beliefs are and the information you get. Because if you're ignoring important stuff, that's pretty serious. Okay. So as I mentioned, I did one study on attention, and so there's 2 ways of looking at attention. That if you focus on one thing, it's going to influence what you do too much. And of course, the other side is if you ignore something, that makes for bad decisions as well. On the focus side, Brad Barber and I did this study where we asked ourselves, how do individual investors pick stocks to buy? There are thousands of stocks out there. So how do you know which one you want to buy? I mean, if I was to give you little folders with information on 500 stocks and ask you this evening to go through those folders and rank order the stocks in terms of the one you like best, second best, third best, most people would find that a horrible task. It's like, oh, gee, that's not the type of thing human beings like to do. So how do investors choose from those thousands of options? What we think happens for most investors, not for all, but most individual investors, we think what happens is the stock catches their attention, and then they decide, I like it, I don't like it. So suppose that there were 10 attention-grabbing stocks in the news one day. You know, they're on the front page of the Wall Street Journal, or if you turn on the TV, people are talking about them. And I read about them, and let's say there are 2 investors, Clark and myself. And I'm a momentum investor. I believe that what goes up, goes up. And we'll say Clark is a value investor, a Graham and Dodd style. You know, he's an accountant. He can read these annual reports. So we look at those 10 stocks, and I see something that's had positive earnings surprises for the last 3 quarters. I think, yes, that's for me. Clark looks at the same 10. He doesn't like the stock I like, but he sees one that has sound fundamentals. It's been out of favor for a while. He says, yeah, that looks like it's got good value. So our differences in beliefs and style matter, but attention takes the choice set from like 5,000 down to 10 or 20, and only then do our preferences and beliefs enter in. So if this is true for individual investors, what would you expect to happen? Well, you'd expect that attention-grabbing stocks were being purchased inordinately, like disproportionately much by individuals, but not sold. And why not sold? Because attention doesn't affect selling very much. In the data sets I've looked at, individuals tend to have 4 or 5 stocks. If you want to sell, if you need to sell something and you only have 5 choices, you can say, do I want to sell A, B, C, D, or E? If it's not December, you're probably going to sell one of your winners. If it is December, you'll sell one of your losers. But the choice isn't, you don't have this big big problem of spreading your attention around. So what we think happens is that when stocks grab investors' attention, they're more likely as a group to be on the buy side of the market. And that's just what we find. So we had a theoretical prediction where along the horizontal here, we're saying these are the stocks that we use two proxies for attention. One is trading volume, abnormal trading volume. We say if a stock is trading more than it usually does, people must be paying attention to it. Now remember, our prediction isn't that people will trade it more. It's that individuals will be on the buy side of the market. So if we sort stocks horizontally on trading volume, the vertical axis is the fraction of, well, it's actually the number of purchases minus the number of sales divided by purchases plus sales. So it's a measure of how much investors are on the buy side of the market. And our prediction is that as trading volume goes up, individuals will be more and more on the buy side of the market. When we looked at three different data sets from individual investor trading, one at a large discount brokerage firm, that's the blue line, about 66,000 investors. The green line is 670,000 investors at a full-service firm. And the red line was 14,500 investors at a small discount brokerage firm. In all cases, as abnormal trading volume went up, the individuals were more and more on the buy side of the market. The other proxy we used for attention was the previous day's return. Our prediction was that individuals would buy yesterday's big losers and big winners, and that's exactly what we find. Particularly so at the discount brokerage firm, we find that people are on the buy side of the market for yesterday's losers and yesterday's winners, and they're sort of ignoring the stuff in between. Now that's active attention. That's paying attention, that's focusing on the thing that catches your attention. The other aspect of attention is what you miss. So I'm going to tell you about a study that some friends of mine did, James Troy, David Leibson, and Bridget Madrian. And this is another experiment. It was an interesting experiment. They got a large sample of students at Wharton and staff members at Harvard, and they'd give these people the prospectuses for 4 different S&P 500 index funds. These were all S&P 500 index funds. And they chose these funds carefully. They chose these funds to vary in fees. Some of them were very expensive, and some of them were not very, very low fee, but lower fees. And they varied in the historical return. One of the stocks had a much better historical return. In fact, we can put it up here. The Algernon there had the lowest fees, approximately $255 on investment of $10,000, and the lowest historical return. And the Phoenix Insight had the highest fees, more than twice as high, and double the historical return. Now, why would one index fund have twice as high an average historical return as another index fund? Because it had a different inception date. This one was started before a run, a big bull run, and the other one was started after it. All right. So what makes this interesting is there was real money on the line. In one of the variations of the study, people were told that they would get the return on that $10,000, on a hypothetical $10,000 over the next month, what an investment of $10,000 would have actually netted for that month. And it was potentially a few $100s, so it was substantial. They couldn't lose money because, the Human Subjects Committee won't let us run experiments where we take a lot of money from people. That would be so easy. So what do you think people chose? I mean, obviously, I wouldn't be talking about this if the choice didn't go this way, but more people put their money into the Phoenix Insight Fund, which had the high historical return and the high fees. So it meant that if they made anything, they would make $300 less than if they had chosen the Allegiant. People just ignored fees in a situation where fees were the only thing that were going to matter, and focused on historical return when it was completely irrelevant. Wharton students, Harvard staff. Most of the staff had college degrees. Many of them had advanced degrees. People chase performance, and they ignore fees. I did a study with Brad Barber some years ago. We looked at new money going into mutual funds at a discount brokerage firm. We found that 39% of the new money was going into funds that had been in the top 10% of return the year before. Over half was going into funds in the top 20%. Yet there's study after study that shows that 1 year's performance by a money manager doesn't tell you, it tells you virtually nothing about that manager's ability. Yet people behave as if it's telling you everything. So I want to talk a little bit about why. Why do people behave this way? Well, I think because we draw analogies. We learn sort of like by analogies from the rest of the world. We develop narratives that are sort of coherent. And we draw a lot, we draw a lot from things like sports. So what do we see here? This is Beijing, the 100-meter finals, and who's out front? Yeah, Usain Bolt. This is 4 years later in London, and who's out front? Same guy. Pretty persistent, right? So I think people just expect that sort of persistence in what in all sorts of areas of life. And a question that one of the questions that faces us is what types of things in the world depend on luck and what are driven primarily by skill and effort. So I want to sidetrack for a moment, then I'll come back to this. I'll tell a little story that I think helps illustrate how people think about the sort of skill and luck. And this is a story about myself. It's a hypothetical story. That means it didn't really happen. It's a hypothetical story about Clark Blackman and myself. And the story begins with us going down to the Amazon River on an expedition. And we are too adventurous, and we get separated from our group, and we've got water filters, but we don't have anything to eat. And we look around ourselves, and Clark eats some of these plants in the foreground, and I eat some of those dark plants in the back. And I don't know if he knows more about botany than me or what, but I get sick, and he doesn't. He feels good. Next morning, I wake up. I'm feeling good again. I've recovered my appetite. What do I eat? Or more importantly, what do I not eat? I don't eat the thing that made me sick the day before, right? Okay, a couple weeks later, we're back in the States. And we're happy. We had a great time. We want to celebrate. Hey, where do you go to celebrate? You got it. There he is. In Las Vegas, in the money. We head right to the roulette table. Oh, it's not spinning. Well, it was supposed to spin. In any case, he puts his money on the red. I put my money on the black, and the little ball lands on the red. He wins, I lose. Next time I bet, does it matter if I bet on the red or the black? No. So what's going on here? We got two situations where we each made a decision. He made one decision, I made another. His worked out well, mine worked out badly. In one case, the outcome affects my future behavior. In the other case, not. And that's because I'm learning by induction, by observation. But I'm also learning by deduction. And I can deduce, I can figure out that if a food makes you sick the day before, it's probably going to make you sick today. Actually, you don't even need your mind to do that. Your body knows it. You don't even want to look at the thing that made you sick the day before. But I can also figure out that where the little ball on the roulette wheel goes one time doesn't tell you much about where it's going to land the next time. So, there's this question that faces investors, which is where on this continuum from completely random to completely deterministic does the market lie? And I think that the market, it's not completely random, but it's more random than a lot of investors realize. And so they see patterns, and they expect those patterns to repeat. And the investors that keep trading on patterns that aren't real, that's expensive. One more story. I want to tell a story is why I think we tend to see patterns so much. Why it's almost just one of the things human beings are constantly doing. So evolutionary psychologists tell us that a lot of our psychological makeup probably developed during hunter-gatherer times, though undoubtedly a great deal of it preceded hunter-gatherer times. But I want to tell a story set in hunter-gatherer times. Two hunters go out hunting one day, and they're about to go around a big boulder, and they hear a roar. And one of the hunters goes around first, and he gets killed by a tiger, and the other hunter runs away. A couple weeks later, the surviving hunter is out hunting, alas alone, and he's about to go around the boulder, and he hears a roar, and he thinks to himself, roar, tiger, and he turns and runs. Now, the statisticians in the room are probably thinking, come on, everyone knows that a sample of one is not statistically significant. He should have tested the hypothesis. But no, the dude ran and lived to tell the tale. All right. Now let's say a couple weeks later, he snares a rabbit one day. He and his family or his friends eat the rabbit. All that's left is the rabbit's leg. He goes hunting the next day, puts his rabbit's leg in his lunch bucket or whatever the hunters carried their food in, goes out hunting, and he has a great day. He kills an antelope and drags it back into camp. Everyone's thrilled. There's a lot to eat. All that's left of his rabbit's leg now is the rabbit's foot. And he says to himself, this rabbit's foot brings me luck when I hunt. And he puts on a leather thong and hangs it around his neck. Now we're thinking, come on. This is superstition. This is a spurious correlation. But what was the downside? It weighed a couple of grams. Maybe he burned off the odd calorie wearing it. It's moderately attractive. Might help him find a mate. In the environment that we developed in, it was more important to see patterns that were real and maybe see a few that weren't than to miss the ones that were real. It was safer to err on the side of seeing patterns. For investors in the modern market environment, it's expensive to be seeing patterns and betting money on patterns that aren't there. Okay, how expensive is it? Well, how expensive is trading too much and trading badly? I took a look, again in Taiwan, and we focused on Taiwan because we were given all the trading records for everyone. And we took a look to see what trading was costing individual investors as a group in Taiwan. And it was pretty expensive. We added up the losses. Basically, we treated this as if, looking at individuals as a group and institutions as a group. On a daily basis, individuals were losing about 178 million new Taiwanese dollars through bad trading choices. They would sell A and buy B, and B would go on to underperform A. There were about 30 new Taiwanese dollars to the US dollar at the time. So it was about 6 million US. They also had poor market timing. They were paying commissions. They were paying transaction taxes. You add it all up, the individual investors were losing the equivalent of 2% of GDP every year through their trading activities. It was pretty expensive. Another way of looking at it was 3.8%, reduced the return on their aggregate portfolio by 3.8 percentage points. 3.8 percentage points. How important is that? Well, imagine, I know you can't get 8% every year, but imagine you could get 8% return every year, and you started with $1,000 and you held it for 30 years. Well, you'd be up to around a little over $10,000 at the end of your 30 years, which would be pretty awesome. If you took 1% away, you'd be at about $7,600. If you took 2% away, you'd be at about $5,700. And if you took 3.8% away, which is what these individuals as a group were doing to their portfolio, you'd be at a measly $3,400, about a third of what you would have had if you didn't, if you'd gotten the full return. So trading losses and fees dramatically affect wealth accumulation. A couple differences. The Taiwanese investors trade a lot more actively than U.S. investors. And when we estimated similar numbers for a discount brokerage firm back in the 90s, we got a shortfall of about 2%, not 1.9%, not 3.8%. The one thing, though, that individual investors face here that was not true in Taiwan is a very high probability that the person on the other side of their trade is an institutional investor. In Taiwan, if you place a trade, probably the counterparty to that trade is another individual. One uninformed person trading with another uninformed person. In the U.S., you probably got a professional on the other side of the trade, so you face more asymmetric information risk. So basically, to recap on the individuals, I talked about overconfidence and recency bias, the tendency to buy the thing you wish you had bought last year. Talked a bit about emotions, both hot emotions like excitement, and then emotions such as regret, and limited attention, where the things you focus on may get too much attention in your decision making, and the things you ignore, limited attention may cause you to ignore things that were important. Let's talk a little bit. I want to talk a little bit about institutional investors, and some of the things that affect institutional investors. I want to start with two very short stories. One is I guess it was spring of 2008, a friend of mine who's a financial advisor, we'll call him Steve. Steve called me up in a panic. And he said, I'm about to lose my living. Well, why was Steve in so much trouble? Steve worked for, what city was it? Smith Barney City? And he, like many of you, had a lot of wealthy clients. And he had put, I don't know, around 10%, I think it varied, but 10% often of the portfolios of these wealthy clients into a product that Citi had been promoting, Asta-Mat mutual funds. They were buying long-term mutual bonds, and they were borrowing short-term. They were leveraged, I guess, around 8-to-1. It was advertised as providing investors with a stable, above-market return with little risk to principal, and the funds eventually lost 80 to 97%. So Steve had a problem on his hands. He had put his wealthiest clients into a product that he had said had low correlation with the market, but similar risk and similar returns. And losing 80 to 90% was not part of what his clients had expected. So he was asking me, what can I do to hang on to these clients? And we had lunch together and worked out a strategy to help Steve keep his clients and stay in business. But the interesting thing here to me is that you could have had Citi promoting something as having little risk to principal and then have losses of up to 97%. Now, another thing, around the same time, in August of 2007, I got this email from a friend of mine who used to teach at one of the top business schools in the country and had moved over to a hedge fund. And he said, in case you are unaware, LTCM, that stands for Long-Term Capital Management, the famous hedge fund that went bust, Part 2 is currently going on in the quant equity space. We're talking about a 10 standard deviation event at least. Tuesday, Wednesday, and today are all huge bad outliers. Half the quant universe at least will be going out of business soon. All quant strategies, including value and momentum, are simultaneously tanking. Both in the US and more recently in Europe, we're talking about hundreds of quant managers simultaneously liquidating their identical positions. So, in case you're not used to the jargon, what he means by a 10 standard deviation event is that what is happening is as likely as getting a draw from a normal distribution that is 10 standard deviations to the left. That means, It's got a probability of 0, and then there are about 23 zeros and then some numbers. I did a back-of-the-envelope calculation, something that unlikely. If you went back 14 million years to the beginning of time, and if each day something had that probability, there'd still only be a 1 in 1,000 chance it would have happened. I mean, it's virtually impossible. So he thought, my friend thought that he had been blindsided by an impossible event, and I'm sure the people at Citi felt much the same. I think that institutional investors, they make, there are a number of biases in their decision making, but some important ones are substitution, I'll talk about that in a moment, and then overconfidence, which applies perhaps even more importantly to institutional investors than to individuals. So substitution. Danny Kahneman once said that actually it's in his book, great book, Thinking Fast and Slow. When faced with a difficult question, we often answer an easier one instead, usually without noticing the substitution. I'll give you a couple examples. One is what economists did after World War II. Economists wanted to create models of decision making. They wanted mathematical models so they could build mathematical rules so they could build mathematical models. And so some famous economists, von Neumann and Morgenstern, developed these axioms of rational decision making. Very reasonable things, like if you like an apple better than an orange and an orange better than banana, you should like an apple better than a banana. So simple rules like this. And then they built up this model of how a very rational person would make a decision. Somewhere, probably in the 1970s, economists started to treat these models and these rules as if they described what people really did. So they went from a model of how people should behave to assuming, well, that must be how people do behave. It was a simple substitution, but a very important one. And in fact, I'm here today because of somewhat of a backlash. Behavioral economics is a movement that comes back and says, oh, wait a minute. These were fine models for how people should behave, but especially when it comes to money, people sometimes don't behave the way they should. And we are systematic in the way we behave differently. For example, the agents in these economic models always had correct beliefs. Humans often have incorrect or biased beliefs. The agents in these economic models were always brilliant. They could solve any problem they were given with the available information. Humans were not so always brilliant. We have limited attention. And the agents in these models were emotionalists, and as we all know, we're emotional. Okay, the other substitution, so one substitution that went on in academic finance, and of course that ended up being taught in our classes, is this idea that people are always hyper-rational when it comes to economics and money. The other big substitution that took place in finance is that we started to treat financial markets like physics. And a lot of the math, a lot of math was imported from physics for finance, and it was a good fit as far as economic models come and go, but it wasn't a perfect fit. And the substitution got ignored. And I think that's really what went wrong in developing, both at this hedge fund and developing the product. So let me give you a little example here. I have a penny. Yeah, I know, it's a big room. Believe it or not, it's a shiny penny. Oh, no, it's not. I have a dime. I meant to have a penny. Now I have a penny. I have a shiny penny. And I'm going to drop the penny. I'm going to count to 3 and drop it. And I want you to just watch. 1, 2, 3. All right? You saw about how fast that fell. I'd like all of you who happen to have a coin handy, like in your pocket or something, to get it out and hold it over the table. Okay? It won't be everyone, but we should be able to get a fair number of coins. All right. Hold them up if you got a coin. I want to see them. You guys got cleaned out last night. All right. That's not too bad. Now, hold your coin like 6 inches above the table because we don't want them bouncing all over the place. I'm going to count to 3. When I say 3, let go of your coin, but watch mine. Okay? 1, 2, 3. As far as I could tell, my coin dropped at about the same speed that time as the first time I dropped it, right? I think it seemed about the same. And that's pretty much how a lot of physics works. You drop a coin, I drop a coin, my coin drops. If all of you drop a coin, doesn't affect my coin. Not in any big way. Now, what if instead of dropping a coin, I'd sold 1 million shares of Facebook this morning? Facebook trades about 70 million shares a day. So, I might have moved the stock a little bit, but, probably not a lot. Now, what if instead every person in this room sold 1 million shares of Facebook this morning? Would that make a difference? What? Well, you got 1,000 people here? So the usual trading volume is 70 million, and we'd have what's that? 1 billion sell orders. I think it'd make a difference, right? You can't. So a lot of the math that was used to start, develop these very mathematical models, like my friend the hedge fund was using, they were just ignoring what everyone else was doing. They were ignoring this aggregation. They weren't realizing that if I do something, and typically if I do something, this happens, it's going to be very different if I do something and everyone else does the same thing. So this got them into a lot of trouble. They basically ignored aggregation risk, and they ignored the feedback, and in doing so, they ignored the feedback in the market. And it turns out, in a falling market, there aren't any natural buyers. So when the market is going up, people like to buy things that are going up. But people also like to sell things that are going up. So, you do get runaway markets, but usually there's some liquidity there because there are buyers, but there are also sellers. When the market is dropping really fast, you don't have any natural buyers as these people are selling. And why are they selling? Well, in the case of the hedge fund, they probably were getting calls from their prime broker saying, your portfolio's dropping in value and you're over leveraged and you have to sell. If you don't, you decide what to sell or we'll sell for you. So, but there aren't any natural buyers because individual investors don't like to buy things that are falling. And value investors, who are the natural ones to step in, they're not in a hurry. If something drops 20% in the morning, they can wait till afternoon. They might be waiting. If you've got a 3 or a 5 year horizon, you might be waiting to let the dust settle a little bit before you step in. So, these people, they were selling because they were getting margin calls over longer horizons. When a fund is dropping, clients start to pull money out. That doesn't happen in moments. And good securities can get pulled down with bad. A hedge fund that sees one position drop and gets a call that says you have to sell. They might not choose to sell the thing that's dropped because they say, well, it's too undervalued now, so they decide to sell this other security. But if a whole bunch of them do the same thing, it gets dragged down too. And what about overconfidence? I think overconfidence affects institutional investors just like it does individuals, and perhaps with larger consequences. I wrote a paper called Learning to be Overconfident with my friend Simon Gervais, and we had a simple model. And it's a simple model in which traders start off not knowing their ability. And they observe whether they're successful or they fail, and in doing so, they sort of infer their ability. But in our model, they make a critical but very common mistake, which is that when they're successful, they tend to over-attribute the success to their own ability. And when they fail, they blame bad luck on other people. They weight more highly their successes. And there's a lot of evidence that that is, in fact, how people behave. And so what we find in our model is that skilled investors do tend to be more successful and do have more ability, but they don't have as much ability as they think they do. So they become overconfident, and in an institutional setting, instead of leading to more active trading, what overconfidence usually leads to is more risk-taking. And for hedge funds, that would be more use of leverage. And I bring these things up in part because many of you are undoubtedly, like my friend Steve, investing in things, in funds and products being run by other people that you don't fully understand, not because you're not smart, but who can understand all these things, and you probably don't have the details on many of them. And in general, I would say shy away from leverage. Leverage can bring you down in a hurry, and it's very likely that the people who developed the product had a model. And as Griffin Tversky wrote, experts who have rich models of the system in question are more likely to exhibit overconfidence. What goes on is you develop a model, and after a while, the model takes on a life of its own, and you say to yourself, well, our model tells us, according to the model. It's as if the model was an oracle. But that model usually is based on some assumptions that are often modeled from physics and on what we call backtesting. And oftentimes new products are based on a short amount of backtesting. They say, well, if you've done this for the last 5 years, you'd be golden. But things happen that didn't happen in the last 5 years. So what went wrong at these funds? Overconfidence, ignoring of this aggregation risk, that when things start to go bad and you're liquidating positions, other people will be liquidating similar positions, ignoring the feedback risk. And the final thing that I think that gets ignored gets ignored in models. It gets ignored often in, most of our models, when I was teaching and as a PhD student, when I was studying economic mathematical models of financial markets, the models were almost always symmetrical. They might, they would do sort of like log normal, but having taken the log of returns, everything would be symmetrical. And, there's been a lot of talk about fat tails. I think what's more important isn't just that the tails are fat, meaning that unlikely things are more likely than you think, but that the world is essentially asymmetrical. It takes a lot longer to build value, to build trust, to build anything than it takes to destroy it. Let me give you a couple simple examples. Pearl Harbor, Bhopal, the Barings Bank rogue trader, Enron, the World Trade Center, Katrina, Lehman Brothers, Mumbai terrorist attack, Bernie Madoff, the BP oil spill, the volcano no one can pronounce in Iceland, the nuclear disaster and tsunami in Japan, MF Global. What do these events all have in common? Whether it's a city, the environment, a bank, a 100-year-old bank, an economy, all of these things took years and years to build value. And to destroy something, it just takes a second. So the world's fundamentally asymmetrical. Bad things happen fast. Good things take a longer time to develop. This isn't built into a lot of the institutional models, a lot of the models that people are using, and so there's risk there that goes unrecognized. Thank you. You've been getting your advice from the wrong place. I was in Norway last year. I'm going there in a couple weeks. And they have a saying in Norway that when taxi cab drivers start giving you investment advice, watch out. So the last thing I have to show you is this is from when I was a cab driver in New York back in 1970. You've been getting your advice really from the wrong place. Thanks.